The best way starts literally with securing the treasury.
Hi everybody, you're watching Value Tokenized. Custody for digital asset has been one of the most discussion-provoking topics recently. How is it different from custody for traditional fintech? Is it actually needed in a security token offering? And who are the main players in the institutional custody battle? Henrik Gebbing, co-founder of digital asset custody solution Finoa, will tell us everything about that. All right, thank you so much, Henrik, for being with us today at Value Tokenize. Can you please start by telling us a little bit more about yourselves and Finoa?
First of all, thank you very much for having me. It's a pleasure. So I'm Henrik Gebbing, co-founder of Finoa, originally from Germany. Studied in Germany, the US, and Spain. Then worked for strategy consultant McKinsey & Company over the last 5 years in financial services. So was consulting as financial institutions, banks, private banks, across the financial sector across the globe. And then personally got into blockchain and crypto from a private investor standpoint, and then quickly saw the potential on financial services that I was consulting in McKinsey. And then very much saw also how complicated it was to handle digital assets and crypto. And that's when the idea came to build something in the space and to start Finoa with my co-founder. And basically very quickly we saw that the pain points are much bigger for institutional investors than for retail investors, because they have much higher risk, because they deal with much higher volumes. And that's why Finoa is targeting. We are live with now is an institutional grade custody platform to safeguard the digital assets of our clients.
And can you give us, so to say, crash course on how does custody for digital assets, for crypto assets work, and what are its main differences from custody in classic fintech?
Mm-hmm. Yeah, absolutely. Where's blockchain technology coming from? It's asymmetric encryption, and you have a private key that's basically the access to the asset. And that private key is at all times the single point of failure, because we've all seen the headlines of private keys being exposed, hence hacked, stolen, lost, etc. A lot of damage has been happening to investors in digital assets, and it basically all boils down to the problem that they've been tampered with their private key, and hence custody in the digital asset space. It's all about the private key. At the end, it's about building technology, both hardware and software, which protects the private key against third-party access. And that obviously is also very different to traditional custody, because traditional custody, you deal with a lot of physically represented assets, made be a piece of paper. They call it, for example, for shares, for company shares, it's called global certificates, where a global certificate is literally a piece of paper, which is with traditional custodians in a vault. Some examples are State Street or Bank of New York Mellon. And that piece of paper then reflects the physical right for the shareholders to that share to the company or to a specific listed company. So completely different technology. It's more about protection. It's more also about accounting and reconciliation. But the private key technology is completely new, and that's why in the custody space for digital assets, that's what it all is about. That you understand the technology, that you understand how to securely store the private key on behalf, at least that's what we do at Finoa, on behalf of our clients, and that you build the technology around it. And it's a lot of understanding of hardware security as well as software, security mechanisms. And I mean, another important point that basically is differentiating from the traditional world is the irreversibility, which is at least true for crypto assets, that once you make a mistake, for example, you send an asset to the wrong address, or as I said, the private key is being exposed and taken by a third party, it's gone. And there's basically for at least for the crypto blockchain protocols, there's no way to retrace it or to get your asset back. And hence the securing or the security around the private key is absolutely crucial and involves a lot of technological expertise that the traditional custody space doesn't really have.
Do you think that custody is actually mandatory? Because some people argue that custody is not an obligatory part of a security token offering. Is it needed legally, for example, in the US and the Europe, and what are the differences?
For security token offerings, STOs, I would differentiate a little bit, because you have the need, or you should have the need, for a custodian on two angles. The one angle is that it's the treasury of the issuing company, because you as a company, you set up an STO token to have investors participate in your company and to raise funds. And at least for the security token offerings that we currently see in the market, there's always the option to invest with crypto. So a lot of investors actually send either Bitcoin or Ethereum to invest into a security token offering. So in that moment, that issuing company is piling up a significant amount, depending on the volume of the STO, but it quickly goes into the millions or even 100 millions. They pile up a lot of treasury of cryptocurrencies. And I think we both agree that if you invest and send your Ethereum to a company that is conducting an STO, you want to be sure that because you invest to participate in the future of the company, and you want the company to use your investment in the best way. And the best way starts literally with securing the treasury, the investments that they get. And I wouldn't sleep very well if I invest a good amount of money in a company and I know that they basically don't really take care of the custody of those assets, and maybe have, some of the crypto assets, Ethereum, on exchanges, or even maybe on a paper wallet below their desk in their office. Hence, that's the first use case in a security token offering, is the treasury of the invested crypto assets. The second use case for custodian is after the issuing. So basically when the distribution of the token takes place, so I invested my Ethereum, in return I get my security token representing, for example, a profit participation in a specific company. Investors also have to deal with that token. They also have to mitigate the risk of losing that token. And obviously, depending on the size of the investment that you have done, you are looking for different options. So those are the two use cases where custodians play a role in a security token offering: treasury of the investment, distribution of the actual security token. If it's mandatory or more an additional service, I mean, mandatory it is when it comes to some institutional investors, because institutional investors, what they do is they take third-party money of very often retail investors and invest it institutional-wise. And for the most jurisdictions, at least in the heart of Europe, once you manage more than 100 million of assets under management, you are basically obliged to work with a third-party custodian who takes care of the security of those assets. It's also it basically comes from the same standpoint that if I give some money to an asset manager who's supposed to create some profits on my investment, I also want him to be completely sure that he has the assets secure and safeguarded. So there is some regulatory mandatory part in it, especially for institutional investors at a higher scale. Then, I mean, on the security end, for me, it almost sounds mandatory that from the security standpoint, you should go with the best provider when it comes to private key management. It's just, I've been investing in crypto myself. I've been participating in ICOs and STOs, and some have been working out. Some teams have been fraudulent. So from a security point, I think custodians play a vital role. For retail investors, you can argue there might not be a regulatorily framework that forces them to use custodians. When I just invest my $100 in a STO, but it's definitely an additional service that sees more and more demand in the market. And that definitely makes sense to include in an STO, also to show that you are a legit team, you have a legit business, you have it set up in a very secure infrastructure, and that there is at no point a moment where the assets that were invested or the assets that are going to be distributed to the investors are at risk. I think that's the role that the custodian plays in a security token offering.
I want to ask something that's not related directly to custody, but for example, we see a larger adoption from different countries like Luxembourg and Germany, because like this blockchain framework bill that Luxembourg passed that basically equals tokenized securities on blockchain to the same thing happening on paper. But if we take a look at the traditional market, it was not possible to just lose your security if you lose like a token. But if it gets like adopted on a level of a government country, but still then it means that it will be possible to actually lose your security in form of a token, and it won't be yours because it won't be backed by any paper asset. Do you think it is a problem, and how it can be solved other than higher security levels?
It is a problem, yes. I think also here we need to differentiate between the use cases of digital assets. In crypto, it's completely true. It's very irreversible. Bitcoin protocol, Ethereum as well. So once the asset is gone, once you made a mistake, it's basically, you cannot really bring it back. For security, security tokens, which represent actual assets, I think what we will see is that the technology is only the facilitator of what we already see in the traditional securities landscape. Because, I mean, we see regulators moving in, and regulators understanding what the potential of the technology, the impact of the technology. And for example, the fact that security, which, let's say it's a share to a company which belongs to a specific investor, that is even known to the company, because there's no anonymity around actual shareholders in a listed company. Anonymity cannot be the goal here. That just by losing the private key, that basically the asset is gone for good. So what we will see is there will be mechanisms being coded into the smart contracts, basically based on regulatory force, that reflects some investor protection. So, for example, that you literally can maybe reissue a token to an investor where you know he's a legitimate owner of that share to a company, but for technology reasons, maybe for the reasons of a technology glitch, which hasn't been seen in the smart contract and the protocol before, but suddenly appears. Then those investors need to be reimbursed, at least because they are a legitimate shareholder to a company. And I think we will see that. We'll see some maturity in that security token space. And I mean, it also reflects, for example, I mean, if you think of dividend payments, you will need to know the shareholder. Even you will need to know who owns the token, because you want to pay dividends to the legitimate shareholder of that that specific share to the company, who has the dividend right. And all those aspects are coming in. The regulators will take their role to actually define the rules of the game, and also to define the functionalities. And I think another interesting aspect is, for example, it's a so-called kill switch. If you have a massive market movement and you see some potential fraudulent behavior in the market, in the traditional world, the regulator can stop the trading of a specific share. It's called a kill switch, basically. That we probably, and I see some STOs right now in Germany which already builds that into the smart contract, that in a moment the regulator says for this specific token belonging to that company, we need to stop the trading right now, because we see there is some inside trading happening, some fraudulent behavior, investors' money is at risk, and we will see that as well in the smart contracting. And hence, coming back to your question, yes, it's needed that investors are protected, and for security tokens, it's a very different discussion as for utility tokens and crypto, as it just requires a more sophisticated thinking, and the technology still has so much potential to disrupt the market, to decrease the number of intermediaries, and to make trading and the transactioning of those assets much cheaper than in the traditional world. But losing the assets for good, as for example a security, is just because of you have your private key gone or stolen, cannot be the only solution. Having said that, yes, we also need secure infrastructures, because we have to avoid that this happens after all. It's the same as in the traditional world. You can reissue a paper-based certificate as well. Anyway, it's protected so that you don't even get there, because anything that has to do with reissuing, reconciliation, who's the actual owner, is already, when you talk about it, sounds expensive. And if that happens at larger scale, that is just something that becomes so inefficient and expensive that then the technology that we now all bet on to disrupt and really help the infrastructure and the financial system at one point wouldn't make sense anymore, because the costs of reconciliation are too high.
Can you tell us more about the technology that Finoa is introducing to the market? What is digital warm storage custody?
Yeah, I think, warm storage doesn't sound like rocket science, right? It's but basically, let me give you a quick introduction of how we got to that terminology. So what we, as I said in the beginning, we are building products for institutional investors, and we were obviously having a lot of conversations with asset managers investing in the space, portfolio managers, trying to learn what the major pain points are of them today. And when you look at the custody part, you have two options right now. And the one is, it's basically so-called hot storage. And if you look at it, it's basically keeping your assets on a crypto exchange, online, third-party provider. A lot of them not audited, not even 100% clear what's the ownership structure. Are they actually from where are they actually based? It's very often very intransparent, and also that's where all those headlines in the newspapers are coming from, that exchanges have been hacked, cryptocurrency stolen, phishing attacks, etc. That's a lot of stuff around hot storage, which is, I have to admit, it's very accessible, because it's just to log in on the computer and you see your assets at best if they're not gone, but it's insecure, so that's the part. Then the very opposite is cold storage, where you have some providers, and I understand where they came from, but they developed solutions as basically putting the private key on a piece of paper, then bringing it into the Swiss Alps, storing it 500 meters deep in deep cold storage in a Swiss bunker with high security guards in front of it. And I have to admit, it sounds secure, right? It does. The thing is, we're talking about digital assets, and where's the digital if you put it offline on a piece of paper and then in a Swiss bunker? And it's just nothing a legit portfolio or asset manager can work with, because at times it takes 24 hours in high volume times 48 hours to get your asset back online. So if you want to really participate in a market that changes every 30 minutes, how do you do that? So you can't really create any alpha. So we said that can't be the solution either. Like it's secure but completely inaccessible. So we said it has to be something in between. It has to be online, but with the security features of a cold storage solution. And again, not rocket science. Why doesn't just everyone do it if it sounds so easy, right? And when we got into that thinking and the technology, we very quickly saw it needs a banking scale technology infrastructure, which includes a core banking system, which you basically take from the traditional financial system. Core banking systems over probably the last 70 years have been doing nothing but accounting, reconciling traditional assets in a very, very secure environment. When you see any hacks in the traditional banking system, they happen because of user failure, but they very rarely happen because core banking system gets hacked. It's just they're very secure in their core stack. We then said, okay, the core banking system, you already see in the traditional world, they work with 6 digits after the comma. They cannot even handle Bitcoin because Bitcoin has 8 digits after the comma. So you really had to, from scratch, change a core banking system towards blockchain methodology. We now deal with up to 20 digits after the comma. Ethereum works with 18, I think. So that's what we did in the very first place. We said we take the best of traditional banking technology and bring it to blockchain. We then connected it to so-called hardware security modules. It's called HSMs, which is basically the gold standard of hardware security. They are tamper-proof, so when you try to enter them from outside, it's a little bit like developed by James Bond, by Professor Q. They destroy themselves, and very, very easily speaking, of course. So it's very hard to attack them from the outside. And we store this infrastructure of core banking system together with hardware security modules. We store in a banking grade data center alongside with other banking service out of Germany. In the banking scale data center is a typical one. You can only enter it with 2-3 people, fingerprint, PIN, etc. So absolute highest scale of data center security. Then we said, okay, we have this infrastructure, we can run it online, but how do our customers access it? What's the front end that they access? We then built a very intuitive online banking interface. It's basically you log in on Finoa, you get to see the different assets, and then when it becomes interesting is how do we actually do the transaction? So yes, we have a very secure infrastructure, but in the moment you transact and you send, let's say, 100 Bitcoin from Xenia to Masha, in that moment there's vulnerability, right? So in that moment we work with a confirmation process, a multi-signature confirmation process, which works with smartphones actually. And in the moment you, as a portfolio manager, initiate the transaction based on, for example, how many people you have in your governance framework, they all get a push to their smartphone, and they see, okay, there's this 100 Bitcoin back to the exchange Kraken. Yes, we talked about it this morning in the meeting. We want to change them against Ethereum or whatever. I use my fingerprint to actually sign it. And that only if that happens, and only if, let's say, 3 out of 5, which you can set in the settings in the governance framework, actually give their approval to this transaction, only then the transaction is sent outside of our hardware into the blockchain protocol. So it's really a multi-signature security layer. Plus, I think what's very important to mention, this is completely separate from the actual assets. The actual assets lie with our hardware security models that I explained in the data center, while the mobile phones are only for the transaction signature. So if you lose your mobile phone, you don't lose your asset. If you lose your mobile phone, you reinitiate your fingerprint with your new phone, download the Finoa app, and hence you can use it again. Your assets are never at stake, only because of your smartphone. And that very much, as I initially explained, very much differentiates from what we see in the market. It differentiates very much from hot storage, very much from cold storage, because at the end, it has the highest security standards while being fully mobile, fully digital. You can access it wherever you are. You don't have to be in a specific place. There's no fax, telephone, or any other more analog process involved. But it's from what we see right now in the market, the only solution that allows you to fully mobile, digitally access your assets in a secure environment.
And how's your activity as a custodial services provider is licensed in Europe, and is it different in the US?
It depends. I mean, as jurisdictions differ, I mean, we have a European Union, but we have a regulator in any European country. They do work together, but then they also have their specific ideas, let me say. The pure custody of private keys, like from a technology standpoint, is not to be licensed. There is no, at least and that's true for Switzerland as well as for Germany and then the European countries, because the current regulatory frameworks just doesn't cover this idea of storing private keys, which in a second layer reflect an asset. But honestly, also we as Finoa, we don't really care what that private key actually gives you access to. We only protect private keys. If it's a cryptocurrency, if it's a utility token, if it's just an access to some data, like Filecoin, for example, it doesn't really matter to us because the technology is the same. We have to protect the private key for our customers. And hence that's where we play, which doesn't mean that the regulatory frameworks will change. As I said, the regulators understand very much now that this technology will not just go away. It's been here for more than 10 years now. It's not a trend that just disappears after 2 years. So they move, and that's why we also, for example, are in close contact in Germany with the BaFin, the local regulator, to kind of proactively bring us into the regulatory framework, because we also understand, as I explained in the beginning, a lot of institutional investors require to work with a custodian, and they're actually required to work with a qualified custodian. Qualified means a regulated custodian. And that's why we are trying to be very close to the regulator to, in the moment, the license for the private key handling is actually adapted. That's when we want to have it. And that's what we see in Germany. I think more or less that's also true for the United States for the pure management of private keys. In the moment you offer, for example, trading, let's say you offer the change from Bitcoin to Ethereum through your platform, and that's actually something we are working on right now as a second evolution of the platform. That's when you touch, at least for the European countries, that's where you touch a broker-dealer kind of situation, because you're actually handling assets on behalf of your clients and trading them. And that's already, as of today, a regulatorily, the business model that has to be regulated.
That in one of articles by Finoa, I think on Hacker Noon, institutional custody is named one of the biggest open battles to facilitate market growth. Can you explain a bit that point, and who are the main players in this battle?
Yeah, why did we call it the main battlefield? I think what we see right now is that the institutional money inflow that everyone is expecting is a bit lagging. And we see that it's also lagging, and we see that in conversations as well, because there's a lack of professional services around. It's just that traditional asset managers who manage third-party money do not feel comfortable to move into the space because of all the risks and headlines they've seen over the time. So negative sentiment around crypto. And I think we touched enough what can be done to change this. And the current players that we see who also understood that there has to be something happening to help institutional investors to deal with digital assets and with the private keys, they come from different angles. Like one clear group is the crypto exchanges, which kind of, based on the nature of what they've been doing, became somehow custodians, right? Because at any point in time, they were having significant volumes of investor money on their platforms. Some had good security mechanisms, some not so much. We've all seen the hacks. So they then started to think, well, let's just verticalize our business model and also offer custody services. And I think, for example, Coinbase custody in the United States is one of those examples where they came from the crypto exchange and now moved to custody services. I think also to differentiate as Finoa, they came from first of all from the retail space. They have retail technology, and they come also less from the banking backgrounds. They haven't built the whole exchange infrastructure on banking technology as we've done it as Finoa. So they had a little bit of a different angle to enter the space. Another interesting part is that in the traditional financial system, exchanges, like the New York Stock Exchange and custodians are regulatorily separated, which makes a lot of sense to diversify the risk, right? Because you don't want to have the same massive amount of risk with the same player who, on the one hand, gives you access to the exchange, to the trading, and also stores the assets for safeguarding. It's just there we come to this too big to fail question. Like at one point, it's a critical amount of volume stored with one single point of failure, basically. So that's why we think through regulatory changes, they will get problems to actually get very significant in the custody space. A second group that you see is the cold storage providers that I touched already. They came from the standpoint, okay, we have to secure the private key by any means without thinking too much, to my point of view, about the functionality behind it, the usability. And also we discussed this. Some of them might try to move into that space. It's again a very different technology. They have been building their technology around cold storage to just change it to basically just plug in, let's say, a hardware security module, which they currently have offline in a vault as cold storage, to just plug it in without the whole infrastructure around that we, for example, built at Finoa. Is a big risk. They don't even have, probably, and I don't want to say too much, but they don't even have a tech talent at the moment to do so. So I'm curious to see where the cold storage providers will move. Maybe they will always have their existence for people who literally, just like a barrel of gold in a bank vault, who never want to touch their digital assets. They just want to have it, passive investment, have some Bitcoin exposure, put it in a vault, and never touch it and wait for the market to increase. For them, that might be a solution. The third group is traditional banks, where you see a little bit of movement now. You have Goldman Sachs, Fidelity, they have made some announcements that they work on custody solutions. Very concentrated geographically in the United States. Also, very narrow in the assets that they provide. For example, I think most of them only provide Bitcoin, maybe Ethereum. The problem here is that the SEC as a regulator is probably one of the hardest regulators to work with, and you want to be very careful in introducing those new assets. Another thing is that with the it's basically coming from the problem that traditional banks are already regulated, and if they take crypto assets right now on the balance sheet, they have to hold a significant amount of equity against it. It's basically 100%. It's called a risk-weighted equity based on the risk they have in their balance sheet. Comes from the regulatory frameworks as well. So bringing in digital assets very quickly piles up their equity requirements that they have to hold against it to secure those assets, and that very quickly becomes, because banks are all about leveraging themselves, and that very much comes very quickly with a price that is not so attractive for traditional banks at the moment. Also, as the market is just not so big that they would put the traditional business models at risk. I mean, I understand the thinking. It's just, I mean, what we bet on is that some of the traditional banks miss the train, when digital assets really start launching off. Then the last part is traditional custodians. As I said, State Street, Bank of New York Mellon. They have the same problem with the balance sheet, first of all, as the traditional banks. Plus, as I think also mentioned in the beginning, very different technology requirements that they need. And actually, we've been talking to some of those traditional custodians who literally asked us for our technology because their current tech cannot handle those. And they just right now don't have the talent to build this and to build it into their running infrastructure, their running core banking system, etc. So right now, you don't really see any traditional custodian moving into that space with a lot of noise. And hence, I think already talking about it, it's a very interesting kind of situation because you don't really know who is moving, in what direction, different technologies. And that's why we at Finoa believe this is a sweet spot to be in, because we expect there's at least another 3-4 years for fintechs like ours to evolve and to reach a significant size that makes you relevant. And then you can also take the battle against existing institutions because you already had a head start in terms of technology development that is not so easy to catch up with. And that's basically what you see in the market.
And talking about the market, I think last year you published a report at Finoa that said that the tokenized asset market will reach about 20 trillion in the next 10 years. And can you tell us in general about your view of this market and custody included? What are the main trends here?
It's actually 24 trillion even that we forecasted. And maybe let me give you a quick introduction of what we did. We did a classical market sizing exercise. Me and my co-founder come both from the consulting background, and we all about numbers in that sense. And when we entered the space, we wanted to know, well, where's this market heading? What's the potential? So we built this model, basically taking traditional assets, the traditional asset split, and also the projected growth of those traditional assets. And you find a lot of reports from Boston Consulting Group, Oliver Wyman, you name it, even financial institutions expecting the development of traditional asset classes. So we took that growth projection and then mapped it against expectations on blockchain, both bottom up, top down. The top down example is the World Economic Forum, which has its expectations after expert surveys on what kind of impact can blockchain have on the global GDP. And I think the number there is, for example, 10% of the overall GDP across all industries by 2030. And so we mapped that against the financial asset classes. Then also considered that there will be some use cases that we don't even see today. I mean, not only traditional financial asset classes will have a role in a tokenized asset, but the beauty of the technology is that you will see a lot of asset classes that you haven't seen before, and they're going to evolve. And cryptocurrencies are one example of those. And they don't really have a counterpart in the traditional asset world. And other examples are, I don't know, for example, there's a lot of expectations around the tokenizing legal documents. Even as I mentioned, the P2P payment between mobile users, but also Internet of Things, like machine-to-machine payments. These are all use cases with the potential to be on tokenized assets, and they are not even touched in the market sizing that we did. What we currently see, and we're actually doing a second version of our market sizing to reflect the movements that we've seen over the last 6 months, because we expected a little bit more involvement coming from the equity side, like STOs actually on equity. But what we see right now is, at least for which is true for Central Europe, is that bonds or debt titles see a quicker adaptation through security tokens, which is partly because it's regulatorily easier, because you don't need that physical certificate, for example, in the European Union to issue a specific kind of bond that a lot of startups are using now, which you can just put on a token. And when there is no physical representation, you can put it completely on technology. And then we also see that there's some mezzanine kind of titles coming in on security tokens, which profit participation, for example, which doesn't really reflect equity, because you don't get a share to the equity of the company, but you get dividend or profit participation rights. And hence we remodel it a little bit now, reflecting the new development. We still see the massive market potential. We might have to readjust a little bit our 2027 target when we see the tipping point above 20 trillion US dollars, just on the complexity we see in the regulators moving in, and the regulators just by nature don't move from one day to another. It's a process. And we are very happy with what's happening, at least from Central Europe right now. But anyway, it's going to take time. And only then we're going to see the real adaptation curve and the ramp-up curve. But yeah, no, I mean, we are working in this space because we believe in the potential. The pure traditional financial assets already have a massive tokenization use case, plus the use cases that go beyond that, where the technology and tokenization can and will play a role. We completely stick to the projection that there's a massive market potential. And maybe also to put it a little bit into perspective, the last tokenization projection that I saw done by our former employer, McKinsey & Company, reached also almost 20 trillion, so a little bit more conservative, but that one was also purely looking at the financial assets as we know them of today. Didn't really touch any vision on top which includes new asset classes that we just haven't seen and that the technology will bring.
Thank you very much for being with us.
Thank you very much. And let's keep in touch.
Thank you for watching Value Tokenized. Every week we publish 2 videos with the leading experts in asset tokenization field. Subscribe to our YouTube and Twitter to never miss one.